All right. Well, hello and welcome to Builder Partnerships Webinar Wednesday. Our webinar today is Pandemic Financing and Investing for Home Builders. Jim Weigel has put together an incredible presentation for you guys today. I want you to remember as you're going through this, the lessons you're learning here today are extremely timeless and they will also benefit you in good times as well. Before we get started, we do have a few housekeeping things that I want to go over. Although all of you are all muted, Jim, could you advance the slide, please? Although you're all muted, we still encourage you to ask questions. Feel free to ask questions as we go along. We'll try to answer some of them during the presentation. If you do have questions, because this material is pretty intensive, that are a little bit more complicated or complex to answer on the webinar, you're welcome to email myself or Jim. Our information is will be put up at the end of the webinar to get further information on answering that question. At the bottom of the screen, you see the speech bubble that says Q&A. That's where you're able to go ahead and ask questions. And if you need anything else at all, you can reach us through the Q&A or also on the chat function. I am going to go ahead and switch it over to Jim. Jim, if you'll switch to slide one quick last time for me. As you can see here, here's Jim. He's been working in the home building industry. This is his second webinar he's doing with us on our webinar Wednesday. He's been working with us for several years and has worked in banking and also in home building. So he's got a unique perspective and can actually give you insight from both a builder's perspective as well as on the banking side. So the information he's giving you here today is going to be extremely valuable. With that, I'm going to go ahead and pass it over to Jim to go ahead and get started. And I'm going to close. I'm going to hold open for just one more minute, and then I'll go ahead and close that so we can see the results in just a little bit. Go ahead, Jim.
Great. All right. Well, thanks for joining us. We're going to learn something together today about investing and financing in these pandemic times, which may not be all that different from normal times, but there are some things that are a little different. A couple things in my background that I just thought I'd share that I think are relevant to today's presentation. One is my early career, after I got an MBA in finance and marketing, went to work with an investment advisory and financial planning firm, and we did a whole bunch of investment management in limited partnerships and real estate and oil and gas and movies and all that kind of stuff back in the late 70s and the 80s, and I learned an awful lot about investing and how not to do things at that point. Haven't done that kind of investment advisory work in a long time, but still use it a lot. And then when I was in the banking business, actually ran a joint venture department where we joint ventured with developers and builders. And then eventually that turned into kind of joint venture and real estate owned, but in the late 80s and early 90s. But I learned a little bit about the business and investment of real estate, as well as we did some of the earliest mortgage-backed securities and what are now called collateralized loan obligations as well. So we can talk about some of that stuff as we go forward. One thing I want you all to do as we're going through this, I would really appreciate it if you could send me your ideas for actions that can be taken in case certain things happen. So if you could be jotting some of those down as we go through this presentation, I sure appreciate it. Emma Jane, how does it look as far as the poll questions? Does it look like we have some answers?
We do have some answers. I'm going to share the results right now. It looks like most everybody thinks that for answer one, the worst health and economic effects of COVID will happen in the next 3 to 6 months. We have 36% believe that that's the case, with the next lowest one being within the next 3 months. So everybody's pretty much in agreement that it's within the next 3 to 6 months. As far as people being able to wait for the good stuff, everybody is pretty much in agreement. They're willing to wait a little bit for a full box of chocolates rather than rather than have a half a box now. So you got some nice patient people on the webinar with us.
That's interesting. So 14% want a half a box now versus 86% in a week. And then how did it look on that last question? Let me pull that down. Okay, it doesn't really change. Interesting. Okay. Well, maybe we just have some of the most rational people in the world on this call. That's what it looks like. Let me just talk briefly, and I'll get into those chocolate questions in a bit. Just what we're going to talk about, what I mean by financing and investing these days. And right now, there's a condition that exists throughout the world it's adversely affecting our ability to understand things and make decisions to manage quantitative resources, especially money. And that's really the essence of financing, is making decisions about quantitative resources, especially things denominated in money. It's also dealing with getting money from creditors or lenders and investors. How do we finance ourselves? Sometimes we say it that way. And investing is usually a process of devoting some time to an activity that we expect to get some worthwhile result out of. And then it's also an investment or the process of making investments in things that are worth buying or owning because it might be profitable or useful to us in the future. So that's what I'm going to be talking about as we go through this presentation. See if I can make this work. Okay. Now I'm stuck a little. Try this again. Okay. Here's some of the key principles. I'm just going to go through them real quick. I think Emma and Jane, people have access to getting this information later, so I'm not going to go through it in great detail. I'm going to focus a little bit on assets or things that pay you money. If you're not getting cash out of it, then you got to question whether it's really an asset. Risk is something that we usually don't talk about a whole lot until times get risky again. And now we start thinking about it. For example, month and a half ago, we had our executive summit, and everybody was coming in there talking about how are we going to make more profits, and how can we get land, and how can we improve our cycle time. Nobody was worried about sales. Everybody had come off of great years and had a great backlog of sales. Things have changed a bit in the past few weeks. So now we're starting to think about risk an awful lot more. And that's probably a good thing, because the essence of good financing and investing is really all about minimizing risk and getting the returns that we need on top of that. We'll talk a little bit about time value and optionality. Those are the key concepts when it comes to financing, which is it's basically things that we get sooner are worth more than if we get it later. It's interesting that people were way okay waiting for that basically 100% return on chocolate if you wait a week or if you wait a year. Normally, when people are asked that question, especially if they have the box of chocolates right in front of them and they can see it and smell it and look at it, and especially if they're hungry, 80% of people will choose the half a box of chocolates right now, 4 times more. But then if you switch the question and say, will you wait a year for that? Almost everybody says, I'll wait and get a full box. So that's one of the things that's happening, is that we change our criteria. We change the criteria by which we make decisions and make judgments. In fact, you're starting to see that right now with governments. When we went into a lot of these lockdowns or stay-at-home orders, the criteria was, let's not overwhelm the healthcare system and the workers. That's why we're doing that. Now the criteria is starting to change. We don't want people at risk to get hurt, or we've got to wait until we have enough tests or there's a vaccine. So now the criteria is starting to change. We got to just think about how that works when we're making decisions. Let me just go through that a little bit more. Understanding and deciding are really affected by human nature and a new field called behavioral finance. I've always felt that Lee Evans had a great concept. He goes through and teaches you all these things, Chuck and Emma's predecessor. And the biggest thing that I always remember him saying in his gruff voice is, you got to compel events to conform to the plan. That's what he says. So the first thing that implies is you got to have a plan. And all a plan is a whole bunch of preset decisions. You've already decided, here's what we're going to do, here's why we're doing it, here's when we're doing it, here's who's accountable for doing, etc. That's all a plan is. And then the next piece is, what events are we going to compel? Are we going to somehow compel things that we can't control or things that are outside of us or our company? Or are we going to be compelling things inside of us and inside of our company? The activities that we do lead to the results that we experience. In fact, there's an acronym that many people seem to follow with this. It's called BEAR. Just stands for the beliefs that you hold lead to the emotions that you feel, which lead to the actions we take, which lead to the results that we experience in life, good or bad. And so we can certainly control those first three items: our beliefs, our emotions, and our actions. And that's what we do when we're rational. And most of the time, we're trying to be rational. We're trying to be like Mr. Spock on Star Trek, right? The problem is that we are also human beings. And when problems aren't structured well and they're complex, when information's incomplete, it changes, it's ambiguous, when our goals aren't even defined well, or they shift or they contradict each other, or when we have a lot of stress because time is constrained, or we have really high stakes that we're making our decisions under, or we have to somehow rely on interactions with all kinds of other folks, like our employees or our customers or vendors, then we tend to think more like McCoy. Our emotions kick in. It's very quick. It's our default way of making decisions. It's automatic. It's effortless. Things that we tend to move towards things that are similar or familiar, or they're proximate in time, something that happened just recently. That's what we pick real quick. And information can be valid, can be important to us, just if we wish it were so. So that's where we're in right now. A lot of these times all these circumstances exist right now. And so we have a tendency to think systematically irrationally when we're going through that. So one of the key things we can do is start making decisions and understanding the kind of information that we need. So I'm gonna ask 3 questions real quickly, and Emma Jane is gonna give me some answers real quick. This will help me understand where we are again. The first question I have is, do you believe that your community is handling this COVID crisis better than average? Just put in a Y or an N. And I'm gonna wait for about 10, 15 seconds. Shouldn't take much longer than that. Come on, I need you to answer. See if you can go find that chat. Just put in a Y or an N. All right. Oops, I just changed things. Sorry about that. There we go. All right, the next question I have. Do you believe that your company is above average compared to other companies in the home building industry? Yes or no? Go ahead and do the same thing. Go ahead and put that in there.
Can you repeat the question, please?
Do you believe that your company is above average compared to other companies in the home building industry? or in the industry that you represent? Yes or no? Okay. And then my last question, you don't even have to answer this one unless you really want to. And I'm completely fine if you want to. Get ready. Do you believe that you are an above average lover? I love that. Yes, that's one of my favorite questions when I ask in an in-person session. So here's what let me just go through that. What these questions tend to bring out is that we're optimists. We tend to be very optimistic as people. So the first question, do you think your community's above average? If everybody was completely rational, we'd have 50% of the people saying yes and 50% saying no. Usually it's about 60 to 70% say yes, sometimes 80%, and that seems to be the case just looking at this. Most everybody believes they're above average, just like their communities, just like Lake Wobegon, where all the kids are above average. Exactly. Thank you, Diane. The next question is just like a company. Company's the exact same thing. We all believe that our company is above average, and we need to do that. It helps us survive. It helps us do well. The last one is a great question because especially guys, and there are a few guys who actually shouted with all caps. They said, yes, I'm the best lover that there are. And that question was actually asked about Frenchmen, or of French guys, and 84% of French guys said that they were above average lovers. The French women had a whole different opinion. So we'll move on from that. But what I'm just trying to have everybody realize is that we are all tend to be a little bit systematically irrational in the way we look at things. And that's good for us generally. So let's keep going. If I can make this go again. Someday I'll get good at technology. Some of the questions we're going to try and answer the rest of our time together. What are the potential returns and risks we face in our businesses and our personal assets and equity? What can we do to reduce the risks, enhance the returns? What's the impact of having more or less land or cash or even employees, resources right now? When and how should we buy some more land? What's kind of useful or dangerous in economic and other kinds of forecasts? What should we watch as indicators? And how do you think lenders and investors are going to look at me in our business? Opportunities or risks? So let's get through it. We're going to go through this in these 4 different areas. We're going to talk about forecasts and indicators, returns and risks, and then cash, employees, and land, which are some of the key things that people are trying to work on right now. And then lenders and investors. Let me go through this. So everybody knows that forecasts are no good. One of my favorite quotes comes from Kenneth Arrow, who was working for the Allied governments just before D-Day, and they were trying to plan that. And they're doing weather forecasts. Everybody knew they were no good, but we needed them for forecasting. But we love them. We are impossibly incapable of predicting the future, especially about complex things like health throughout the world, or the economy in the world, or even in our local community. The other thing is that this has never happened to humanity ever before. We have no experience to guide us. No disease has ever affected all of humanity almost simultaneously, as far as we know. We've never had governments encourage or require lockdowns, like in prisons, almost throughout the world. We've never had the degree or speed of fiscal and monetary response that we've seen, especially in the US and Europe over the past month. The other thing is we've never seen the suppression of market activities the way we have right now. And by that, I don't mean stock markets in particular. What I mean is markets where consumers and producers make billions of individual decisions about what they're going to do today or tomorrow. At the same time, we love this. We love talking about what's going to happen. What do you think is going to happen next week? How are we going to do this? It's just the way we are. But they're almost useless. They tend to cause all kinds of problems if we pay attention to forecasts, except to try and figure out how to imagine what might happen and what to do about it if it does happen. So like right now, take your pick. We're going to have a V economic recovery where things go down and they start to come back up again, kind of like the stock market's happening right now, or a lot of the virus stocks. Right, Amazon, had a big down move and now it's up again. Or we're going to have a U recovery where it goes down, it piddles along kind of a low spot for a while, then just comes back up real quick. Or we're going to have an L-shaped recovery where it goes down and kind of stays down a long time. Or it's just going to go down and we don't know. Or now we're going to start having some different kinds of shapes where we have a W, which is just a V that keeps happening all the time. Or we're going to have some J recoveries where a reverse J, where it goes down, it goes up a little bit, or a check mark or a swoosh, it goes down and takes a while longer. Or it's going to have some stair step downs, up or down, and up and down. Who knows? You take your pick. I don't know. What's more useful is what are we going to use to make decisions ourselves for our own businesses? Home building industry has some awesome indicators that we can use that have always proven reliable. First ones are internal. Track our traffic, our appointments, our sales, our cancellations, our closings, our starts, our completions. What's going on with those each week, and track some kind of moving average of that over the past 3 weeks to 6 months, whatever's either half to fully your building cycle. If it takes you 6 months to build a house, then track it over 3 to 6 months. See what's going on with that. Track your competitors. What kind of inventory do they have, especially of unsold homes? What kind of discounting are they making? What's their starts? You can just drive by and see. You don't have to go ask them. What's going on in the existing market? What kind of listings, time on the market, kind of the asking price to the closing price. You can see what's going on in your market right now, the best stuff ever to track. You can talk to developers, lenders. Are they getting more activity or less? Are they experiencing more problems or fewer? What kind of deals do they have? The next biggest kind of indicator for our industry is employment growth, especially in your community and state. Right now, it's pretty substantially negative. We've probably got 22 to 30 million people unemployed right now and in the country, and it doesn't seem to be abating. So what even more important, what's going on in your area? What's going on within your customer base? Are the folks, you've got to talk to your customers and say, what industry do they work on? What occupations do they have within those industries? And then track what's going on with the employment growth or decline in those industries and in those occupations, especially in your community and state. There's all kinds of great local resources to give you that information. One of the best sources of information are permits. Are they going up and down, especially in the jurisdictions you build? That tells you your market share compared to what permits you're pulling. The other thing is figure out what's going on with mortgage terms. Are interest rates going down or up? Are loan amounts going down or up? Right now, rates are great, more loan amounts are getting restricted. It's hard to get those bigger loan amounts anymore. Qualifying requirements are really getting hammered right now. Debt to income requirements are getting more stringent. Credit scores are becoming higher. And then what kind of industry problems are occurring? For example, I think it's gone up over 50 times the forbearance and default rate on mortgages in the past 6 weeks. It's gone from 0.25% to I think it's over 6.25% right now. So it's just climbing. The other things are psychological indicators. One of the simplest ones to me was you go to Costco and do they have toilet paper or not? Are the things that are out, what are they back in the next time? Are people smiling at you or frowning at you or running away in fear when you go for a walk? There's all kinds of things you can use to see, are things getting better or worse in our industry? Don't rely on all these forecasts. The next thing we need to do is be making decisions about our future actions. What are our plans using those forecasts? So if a forecast is really low or if it's really high, what am I going to do if it's really high or really low? If my sales go up or down 5 or 10% or my backlog, I will do this. When it comes to land or employees or other actions, if something occurs, whether I have a huge influx of cancellations, here's what we're going to do. We're going to try and discount them or do some more options or upgrades, whatever your choices are, but predetermine it. That's all a plan is. Prepare it before it happens. Be talking about all kinds of folks. Consider what's worse than even the worst forecast that you can find an example for. Or what's, rather than forecast, look at historical examples. Or right now, if you're in an energy producing state, what happens if oil prices are negative $100 a barrel? Or what happens if within the next 12 months, maybe they become $100 plus a barrel? What happens with those kind of switches? Talk to people who make you think, especially the people who don't agree with you, who can give you the pros and cons of something that's going on, both short and long term. Try and falsify what you believe. Don't try and confirm it. That's what we all want to do, is have people tell us what we believe. We want to listen to the news programs that talk about things the way we believe it. Go find things that disagree with the way we think. Chuck, do you have any comments or questions on any of this so far? Feel free to jump in when you do.
Oh, I got unmuted.
Okay.
But I totally agree with what Jim was talking about with the decisions. I mean, this is critical, especially right now. You need to go out and you say, okay, what if this happens? What actions am I going to take? And it's a plan of action. You may never implement the plan of action, but at least you have done it without the emotions, with the employees. If you wait on making a decision about what you're going to do with your employees, or am I going to reduce my salaries? Am I going to let some of my people go? If I wait, I'm going to postpone the decision, postpone the decision, postpone the decision. Every builder that went through the recession told me the hardest thing they had to do was to let their staff go. And from Emma's study, the thing that we saw is builders held on to their staff probably a year to a year and a half longer than they should have. And that company actually went negative in profitability, mainly because we kept our overhead too high for the amount of volume that was going on, because we didn't do the decisions early on and put a plan together. So I totally agree with Jim. I mean, the guys are going through, what do I do about my land? If this, what do I do with the land? If this, what do I do with land? Exactly the same thing. And not only are you putting a plan together for the down, but also what about the recovery? What kind of decisions are you going to make for the recovery when it occurs, whenever it occurs? So I totally agree with what Jim's talking about here.
Thanks, Chuck. The other thing is, everybody's going to make a plan, and that's going to change. As soon as reality hits you, you're going to have to modify that plan. If things start happening differently, we're going to have to change our plan. So keep track of those indicators. Be prepared to modify your plan as things change. And be careful you're not relying on some kind of forecast that things will get better. Just pay attention to things the way they are today and the way they have been in the recent past. If things are going to get better, you'll see it in your indicators. I guarantee it in our business, it happens every time. So here's some simple examples. If our community starts opening up or starts locking down again, Here's what we're going to do with our employees. Here's what we're going to do with our trades. We're going to do with our customers, our lenders, our investors. If our traffic or our sales or cancellations start going up or down by 10% or by 5 units a month or something, here's what we're going to do with that same group of people, right? The next thing, most important thing, the thing I hear from Emma all the time, it rings in my head every day. Discipline, discipline, discipline. You got to do the plan. So no matter how good our plan is, if we don't actually take action to implement that plan or that decision, it's just a whole bunch of nice wishes. And it's very hard to do sometimes, especially when it deals with people, especially when it goes against some of the most deeply held beliefs about what's right and wrong, what we should be doing. But just be careful when you're putting your plan together. Think that through. Think through what's called in finance and decision making the mini-max regret. How can I minimize the maximum regret that I'm going to have by doing something? And the simple way to do it, let's just take a land decision. If I give up this option and the thousands of dollars that I still have riding here and don't take any more, what am I going to regret more in 6 months? Having giving it up, or having not having the cash because I didn't give it up? Which way is going to give you more regret? It's one of the easiest ways to figure out what's the right thing to do. Let's go through some of the returns and risks that we're facing right now. Most of the time, we don't pay a whole lot of attention.
Hey, Jim.
Yes, sir. Go ahead.
One of the things that hang people up is, I've got $50,000 in the land. That $50,000 is gone. That decision was made a long time ago. And it shouldn't enter the equation at this point and what the decision's going to be.
That's exactly right. What Chuck's talking about is sunk costs. It's a very straightforward finance and economic principle. The only kind of costs that are important to you are the things going forward, the ones you have to make today going forward. Everything that exists right that you've paid for in the past doesn't really matter, but it's hard for us to get over that. Anything else, Chuck? All right. Keep jumping in there. What we want to become is a professional risk taker and a manager. And what we do, those folks, the professionals, consider risk first. How can I minimize or mitigate or eliminate the risk? And then I look at my return. Most people don't do that. Most folks are saying, well, this land is going to be this kind of return, or I got to have this land, otherwise I can't keep building at the volume I want, that kind of thing. What we want to be careful of is, what's the risk that this is what we're taking on going forward with this? And what I'm talking about by risk is the simplest way to measure it is a temporary or permanent loss of value in an asset, or an increase in cost from a liability. Or subtracting the two, it's a loss in value of our net worth. Sometimes people call this a drawdown. In the effect of risk, when we have drawdowns, is it hurts our long-term returns, and emotionally it makes it difficult for us to make rational decisions. So we have to be ready to figure out the risk of what are we going to do if our house prices drop by 5% or 20%. What are we going to do? How are we going to feel when that happens? What are we going to do if the value of the land that we purchased drops 20% or 40% or 80%? What are we going to do at those points? And how do we pay attention to that to make sure that we're mitigating that risk as much as possible beforehand? Let me just go through real quick the mathematics of this, because it's very straightforward, but we don't get it until we're in the middle of it. If you've experienced some of the stock market drawdowns the past month and a half, you kind of get it. So when something drops in value by about 20 or 30%, it requires a 25 to 45% return to get back to even. That's not that bad. So if something's going down 20 or 30%, that's not awful to try and recover. But when it starts going down more than that, I mean, look at 40%. It takes a 67% return just to get back to even, right? If it goes down 50%, if something goes down a half, we have to double our return just to get back to even. So that's why the impact of these drawdowns on our overall long-term returns are just huge. They're so big of a deal that having drawdowns of more than 20 to 30% really cause us to have major problems in our lives, in our investments and our businesses. So for example, what we're hearing all the time, if the economy declines 10 to 40%, what does that mean? That means that if it declines 40%, that means it has to go up again 67% just to get back to even, just to get that nice V recovery. If your business volume goes down 50%, you have to double your business volume to get back to even. Same thing with your investments. And everything that you have on your balance sheet is an investment in your company. If home prices drop 5%, okay, they got to go up 6% to get back to even. If they drop 20%, they got to go up 25% to get back to even. Same with land prices and stocks. And I'm putting in there the normal historical changes in drawdowns in value that people have experienced. We have experienced 20% drawdowns in home prices pretty regularly. Land prices 80% or more, sometimes 100%. You can't even give away land sometimes. Stocks easily 80%, generally 40 to 60%. Bonds, especially when interest rates are less than 1%, I'd be surprised if we don't start seeing some 40% drawdowns in bonds if interest rates ever rise again. The other thing is volatility. It's not just that we have a drawdown, but if we have income that goes up and down a lot, that also hurts our returns. So for example, if we have our income growing up in our business, our net income's steadily going up every year 5%, this feels great. We're a very good business. We're growing our income every 5%. And then we have a tough year and it goes down 20%. Well, the average return that we had is just zero. 4 years at 5%, 1 year at 20%, zero. But what we really experienced was a negative 3% decline in our income, in our value. So what we have to be careful of is that we're not paying attention to average returns all the time, which is exactly the way people sell us. Brokers talk about that. Investment folks, economists, everybody talks about average returns. What we have to do is convert it to compounded returns, because that's the way we actually experience it in our lives over time. So just go take a look. A great way to look at it is just look at your monthly income statements. How do they change? Look at your quarterly statements. What's the annual return on your equity, and what have you experienced on that every quarter, every month for the past 5 to 10 years? Just go see how that varies over time. The more volatile that is, the more your returns tend to decline from the average. You're really not getting the average returns you think you're getting. Go look at your personal returns on your retirement accounts or your investments. Go see how they change monthly, quarterly, annually, and the more volatile they are, the less return you really are getting compared to the average. The other thing is, and we'll probably all experience this at times, if we don't look at a financial statement or a monthly return or read about it in the paper, we tend not to worry about it so much. So one of the easiest ways to not get bothered by this is just don't look at your financial statements. Don't look at your monthly statements from your brokerage accounts. It won't bother you as much. Or you can actually take some actions and say, if it goes down this much, here's what I do. If it goes up this much, here's what I do. The other thing we tend to do is we always tend to brag about the good investments we make. And we tend to not really talk a whole lot about the unfavorable ones, the ones that don't work so well. So start paying attention to those unfavorable ones. In fact, the most professional investors that I pay attention to tend to talk more about the losses they've experienced in their lives and how they've dealt with that they're the ones who last the longest and make the most money. They seem to be the best business people I've seen, especially in the home building business or any other business. They talk about their losses and how they made those mistakes and what they're going to do in the future to avoid it. Great way to start thinking. Here's a simple way to look at it for a home builder. You got cash. You're really going to have a negative return on that cash, but it doesn't cost you anything. It's a nice balancing. It's a nice way to balance your assets by having cash, whether it's on a personal statement or a business. We tend to have homes under construction, and those give us a 0 to 3% return, probably in the next year or two. But they could also be exposing us to a 5 to 20% drawdown. Land is going to give us a 0 to 6% return potentially in the next year or so, but it's going to expose us to a 20 to 80% drawdown. Those are the two biggest categories on a home builder's balance sheet: land and homes. So just pay attention to them. I'm talking about the returns I'm talking about here are after expenses, after taxes, and after inflation. So if you want to have pre-tax and add inflation to it, then you'll just have higher returns. Same thing on your personal balance sheet. You know, your home, your residence is going to go up or down, but then people also invest in bonds and equities. Again, after expenses, after taxes, and after inflation, here's the returns I'm talking about. And most people have expenses that are about 1.5 to 2.5% already. So expenses are a huge part in your retirement account assets, in your personal investments. They're big numbers. So bonds and equities may turn out to have the same after tax, after inflation returns over the next 10 years, given the current valuations that we're at right now. But they may have drawdowns anywhere from 10% to 90%. We'll see. So what we want to do is figure out, can I withstand those kind of drawdowns, or can I reduce those drawdowns? And every time you reduce those drawdowns, you're actually going to improve your returns over time. I don't have time to get into a lot of the details on that right now, but hopefully we'll be able to have some other seminars where we can talk about how to make our investment returns work a lot better and have a lot less risk and drawdowns to them. We talked about human nature a little bit. Almost everybody in the stock market for the past 10 years has been buying the dips. Every time it goes down, just buy some more, you know, just let's figure out how to do that. So maybe that's true. Maybe this time it's just another correction and we should be buying some more. Or maybe we should just stay calm. Or maybe we should take some other kind of action. And we do this because we've seen these dips in the marketplace, and we're seeing the exact same thing in land prices. I'm hearing builders right now saying, I can go buy some land at a great deal right now. Maybe so, because it's a dip in the market and it feels good. And it's really close in time to what, you know, just a month or two ago, these land prices were crazy and I couldn't even get anybody to talk to me or answer my phone. But now all these public builders have pulled out and the developers want to sell their land. So now I can get a good deal. And that's just happened in the past month. And now it's similar, because every other time I've bought in land before in similar situations like that, it's worked out for me. Well, maybe it will work out this time. But maybe not. Just set some rules for yourselves. So let's talk about that a little bit for cash, employees, and land. Well, I'm going to talk about the main thing. I've been hearing Chuck say this for years when we have different recessions, but almost every day I'm hearing him say something like this: raise cash, preserve cash, protect cash. I'm going to talk a little bit more about protecting cash in a moment when we talk about lenders and investors and banks. But the key thing is keep your cash. And so the most important thing we're trying to decide right now is, should we trade off cash for keeping employees longer or for buying land? The biggest suggestion I have is decide, make some decisions about how much cash do I need to have on hand? How much cash should I have as a percent of assets? Should it be 10%? Should it be 15%? Make a decision. Where would you feel awful if it got below that level? And that's the key level. Where would you start sleeping like a baby if it got below that level. And what I'm talking about as a baby, as Chuck reminded me earlier today, is you wake up every few hours at nighttime and you cry. So we just don't want you being that kind of baby. I want you to sleep soundly. How much cash do you want to have as a percent of your debt? Do you want to have it be 10% or 20%? How much cash, and this is my preference, for the monthly fixed expenses I have, how many months do I want to be able to maintain my fixed expenses with my cash balance? And, you know, typically for personal use, people recommend anywhere from 3 months to a year's worth of cash for your monthly expenses. I would say almost the exact same thing when it comes to our home building business. You know, most people probably don't have more than 2 weeks to a month's worth of cash for fixed expenses. Most businesses don't have that. And I think that's the same for all the home builders I've seen as well. So start deciding. If you don't have a whole lot of cash, then you got to be moving on reducing those fixed expenses more quickly. And then how much cash do I want to keep on hand for potential land deals? That's what I want to figure out. How much do I want to start building up? You don't have to have all that cash right now, but how much do I want to start building up? And if you guys believe, as we heard earlier in the first question, that we're going to be out of this somewhere in the next 3 months to 12 months, how much cash do I want to start building up so that I have more and more cash in the next 6 to 9 months to take advantage of some things that might be happening? And then go through the other side. Here's how we increase cash. And in home building, it is so damn simple. I can't believe how simple it is in the home building business. And I've done this many times, both in starting home building businesses and closing them down or helping them get to a very manageable level. The key thing you have to do to build starts, you've got to have closings to build cash. Number one, your closings must exceed your starts. If you are starting more homes than you are closing, you will not build cash. There's only one exception to this, and that is if you have a kind of draw where you're front-end loading the draw requests that you get. If you are front-ending your draws, then you're going to have to balance that very carefully. You're going to want to try and start being careful on what you draw up front, and then you're going to have to balance those closing and starts for a while, and then start having the closings exceed the starts. The second thing you do is avoid additional land commitments. Just don't put more deposits down. Don't put more land under development unless you know you're going to use it in the next few months. Don't go buy more land. Don't go put a whole lot more cash out for land for any reason. And then the third thing, start matching your fixed expenses to your current sales volume or your sales backlog. You pick which one you're going to use, but match it to that level. Don't let your sales volume go down for 3 months, 4 months before you start cutting your fixed expenses. Don't let your sales backlog drop by half before you start doing something about your fixed expenses. It's a real pain to let someone go, even temporarily. I can't stand it. Key people are good. We have a connection to them. They're almost like family. We've had battles with them. We've had great times together. Everybody's like family if they've been around that long. This is a real pain. So emotionally and from a human connection standpoint, it's awful. The other thing is, if you just look at it coolly, they have great value. They have experience with our company, with our customers, with our business, with all the vendors and the municipalities that we work with, probably more experience than we do sometimes. They have great expertise that we can't stand losing. How are we going to replace that? They have knowledge of everything that we've done right and wrong for years. They have know-how and skills and abilities and arts and crafts about how to do things that are cool. And if we don't have many documented, streamlined processes that can be assumed by someone else, then it's going to be really tough replacing all that experience and know-how. The other problem is, as soon as we let someone go, everyone else who remains is just as busy as they can be, and now they got to take on someone else's work, even if it's just temporary. So all that stuff is a pain. but at the same time, we have to survive. So we're going to have to figure out how to take care of what is this employee doing right now, and how can I put that on someone else's plate and make that work well, and how can I make this work temporarily for someone and maybe it work while still being truthful with them, right? How long are we going to have someone out? Who is going to be out? When are we going to review these decisions? And the other thing is, we're not the only one who's making decisions. Everyone who's our employees, they're making decisions too, and they may decide, I'm going to go find another job and do something else, and maybe do something in a different industry, or go to Tahiti or whatever. Who knows what they're going to do, but they may be making their decisions just when you thought you could rely on that person. They've made a decision to leave. So how are you going to handle the folks who you want to keep, but they decide to leave? And in the meantime, take this opportunity, which a lot of the best builders, what I'm hearing them do is we're keeping our folks, and we're going to see if we, because our volume we think is somewhat temporary, but we can handle it for a while. We're going to document all of our process and how we do things. We're going to streamline that and improve it. We're going to cross-train. We're going to help each other through this, both personally and professionally. And above all, we're going to be honest all the time as to here's what we're doing and why, and here's what we're going to have to do under these circumstances. Communicate with them well. Chuck, do you have any comments?
I had to get unmuted for where we're going on this, but I think you're totally on target with where we need to be in looking at this stuff and documenting it and making the decisions. And like Jim said with the employees, when he was talking about the employees, this is the hardest time. And I just wrote a builder. He said, should I start releasing my staff, or should I start reducing my salaries? And I said, this is a time that we all of a sudden realize how many families we're responsible for. And that makes it very, very difficult. I had a framer one time. I had 175 framers working for him. And he and I were talking, and he says, you got to understand, one of the biggest trials I have is I have 175 families that I have to put food on the table every week. And that puts a big responsibility on me into making sure that I have enough builders and enough starts to keep those 175 people working.
Yeah, thank you. And sometimes some salary cuts can work. You got to figure out how that works with unemployment insurance and how people can keep getting things and how to structure it. Sometimes that works. And it might work for some of the higher paid people, and it's really difficult for some of the lower paid people, and it can't last for a long time. So that could work as well. This is a great place to do your little yellow piece of paper, or get out that piece of paper and do that mini max regret exercise.
Jim, one of the things I always tell people is, as you expand your organization, you should have a hit list in your desk drawer of who goes first, who goes second, who goes third. When there's no emotion involved in it, who are my critical people that I have to keep, my core? And then who is expendable? And if they're expendable, what am I going to do with the work that they're doing right now? Who do I have in my core that I'm going to keep that can take that workload on? And have I cross-trained my people so that I am in an ability to reduce staff if I need to reduce staff?
Yep.
Most of us have never thought of it, but that needs to be thought of in the cold, quiet time in your office when you're sitting there and saying, I've built this company, I've got 150 people, or I got 100 people that I'm responsible for. Well, what do I do if the market craters?
Yep. And don't be afraid to talk to people. They know that you're going through these decisions. They're going through the same anxiety themselves. Feel free to go talk to people about, here's what I'm struggling with. Here's what I'd like to do. Here's what I'm thinking of. What do you think? How's that going to affect you?
One of the things that you guys have all done, and we started out with the helicopter with the money, and I was telling Jim, I said, I hope that helicopter flew over all the offices and dumped PPP money. What happens if you didn't get the first round of PPP money? What happens if you did get the PPP money? How does that change your plan? Now we got the second round. I missed the first round. What happens if I get funds in the second round, or I don't get funds in the second round and it's cut off? There are no more rounds. What decisions do I have to make internally within my organization? What are the expenses that I have that are not generating revenue? What am I going to do with my employees? Because we're sitting here with employees, but those decisions should have already been made. Those decisions need to be made by March 20th. April, yeah, April 3rd, April. Yeah, those decisions should have been made somewhere around the first week of April. You should have had a plan of action together for all of that.
Yep. Okay. Thank you, Chuck. Let's talk about land now. Should you be buying land right now? Maybe so. But what I heard a little bit ago, and what normally happens is when we are buying land, we are typically buying the most land at the highest prices when we are at the top of the market, when we're selling the most. So we are at the top of the market when we are taking the most land risk that we're ever going to take. And that's normally what people doing. We're selling the most homes, so we got to replace that land, and the developers and the landowners can get the best price, and we're competing with everybody else. So just realize, when is the best time though to buy land? And typically that's down here when the market sucks. We're hardly building anything. No one else is building anything. No one wants to even look at buying land, but that's usually the best time to buy it. So all I'm trying to suggest is we tend to do the opposite of what we should do. The other reason that I'm showing this here is that a key to seeing when we should be buying land is really based on our own emotions, the emotions of other folks. Typically, when we are the most despondent or depressed is the best time to be buying land. When people have capitulated and said, I've had it, I don't want to buy any more land, I can't stand it, that's probably the best time to start buying land. So my suggestion is we're not close to that yet. We're kind of in the denial and fear stage right now. So maybe there's some opportunities, but I'm going to suggest there's going to be some bigger opportunities, and those may come in cycles. We may go up and down a few times with land. So if you got some great deals and you got the cash and it makes sense for the current volume, go ahead. The best way to buy the land is through an option. Buy that land and put a few $1,000s down and have a decent takedown schedule, because that's going to be the best way to do it. Avoid making huge financial commitments. And I know the folks on this, you get that. You've been dealing with land for a while. Just be careful you don't load up too much. Maybe you want to agree that I'm going to buy one every 3 months, and then just have $1 million, and I'm going to divide it into 5 pieces, and I'm going to buy X amount every quarter, every 3 months. You'll probably get some better land deals. You'll definitely get lower risk by doing so. The reason why is land goes up and down about 2 to 4 times what house prices change. So be careful buying too much right now until you've seen house prices go down a bit, and then look for land to be going down even more. It's kind of sticky. It takes a while. The best way for you to avoid risk is prepare a pro forma before your money goes hard, before you can't get it back. It's a pro forma of, here's the income statement, the balance sheet, and the cash flow that I'm going to have going forward every month or every quarter if I buy this piece of land. And then you compare that to your actual results before you go along, and learn from it and apply it to your next deal. I swear this is one of the best tools to reduce your risk on land and to know what to do in case things go bad on a land deal. Best ways to handle it. Plan for it. What indicators am I going to do? When my sales are this way, when employment's going up, and I would suggest employment is your best indicator when you're buying land. Permits are your second best indicator. Try and buy land when employment is going up and permits are going up. Those are your lowest risk points to buy land. Or land prices are a percent of the peak or a percent of replacement cost. If they're 50% of what they used to be, here's when I'm going to start buying more of. When it's 60%, 70%, here's when I buy more of, etc. How much am I going to buy? I'm going to buy 1 year worth of land or 3 years worth of land based on my current backlog or my most recent 3 months of sales activity. You pick. Start making some decision on that. We just talked about optioning it. And you can also start using investors because they're going to start being very interested in real estate. But you're going to have to decide how long that investor money is going to be out there. If it's for land only, or you're going to let them share in a piece of the house profits as well. But always remember, when you're buying this land, again, something that Chuck talks about, the product that we have coming out of this is not the product we have right now going into it. So make sure that that land you're buying fits the new product that you're going to have going out. It's just going to change. We must be reducing the waste in our new product. You heard all about that last week. I'm going to go through it a lot more. But what I mean by waste is simple stuff, materials or features you should not be paying for, or features your buyer is not willing or able to pay for, including an appropriate margin. Just because you can put it in there and they'll pay for the cost of it doesn't mean you should be doing that. They should be giving you a profit margin on whatever you're putting in that house. And if they're not willing to pay you for it, then you should not put it in. And the land you buy has to work for that new product. So make sure it's flexible enough that you can put on some new product that you don't even know what it's going to look like yet. Chuck, do you have any comments on land before I step into the?
No, one of the things, you know, when we go through a period like this, right at the end, everybody says there is no land, we're going to run out of land. Then all of a sudden we realize we got 20 years worth of land. But all that land is zoned. And when it comes back on the market, I'm probably going to have to rezone it if I'm going to buy it, because it is not built, it was not zoned for the type of product that we need to build coming back out. Remember, we're going to have the baby boomers and the millennials as our main clientele. It's going to be a smaller footprint. It's going to be a different type of a product. And so probably the land that's going to be there is going to be land that I'm going to have to go through a rezoning process or a replatting process or even a redevelopment process for it to work for the product that's going to come out of this downturn.
Yep. Thanks, Chuck. Let me talk real quick before I start getting into the lenders and investors stuff. I spoke with president of a banking organization over the weekend, and she runs a bunch of banks in Colorado, and then they have banks throughout the West. They were all their bankers were in working over the weekend because they're processing all these PPP loans. What happened was, just to give you an experience that they had, which is pretty much the same proportionally to any other lender, including Wells or KeyBank or any of the rest of them. Normally in April, they'll get 150 commercial loan requests the first couple weeks of April. They got 3,000 PPP loan requests. So if you wonder why your lenders are having a hard time getting back with you, it's because they're completely overwhelmed with these loans. The next thing is they're really not getting paid much to do these loans. They're 1% interest rates. They get some fees that are kind of a sliding scale, but they don't get paid a whole lot to do these loans. And the biggest thing is these lenders, their banks, they're very uncertain as to whether the federal government is actually going to buy them from them. Because remember, the PPP loans, you don't have to pay it back if you do the right things with the money. It's forgiven. So the bank's never going to collect on the loan. And they got to make sure that they can sell it to the federal government as soon as they've made the loan. And they're concerned that the federal government's going to renege or say they didn't do the paperwork right or all this kind of stuff. So if you think your lenders are having some trouble with this loan, or they're not responding to you as well, because this is a pain for them. This is a huge pain for these lenders doing these PPP loans. So just be careful. The other thing is that they had to have all these loan requests processed within 10 days. So that's roughly by the end of this week, so that they can tell the federal government, here's how much money we need. So theoretically, that's going to pass. That bill's going to pass today or tomorrow if it gets through the House. But there's probably going to still be more demand even after that. Just my PPP update for all you folks who are interested in that. The key thing here with lenders is you got to make sure you fit with them. Make sure they fit with you. Remember all that cash that we were just talking about that you're going to have? You're going to have $1 million, $10 million, 100, whatever that number is. That's a huge number. If it's more than $100,000, you better make sure that you understand your lender's balance sheet well. You better make sure they're solvent, because every cash account you have at the bank is a loan to your bank. You are now making an investment. You are making a loan to your bank when you have a cash account with them. And if they go bust, you don't have that cash. Maybe you collect it because the FDIC insures theoretically $250,000, but I wouldn't count on it. So if you got some cash, I'd make sure you've got it spread around, $100,000 maximum per bank. I'd make sure you have it in different kinds of names, so that it's related to your estate plan or your business. Make sure that you have different accounts under different names. And I'm not saying be fraudulent about it. Go talk to your attorney and your accountants, and you probably all got different entities. Just spread it around, because right now, if you look at the oil prices, every lender who has loans to people in the oil patch is going to have billions of loan losses and charge-offs. 40% of the folks in the oil patch right now potentially will go bankrupt if oil stays below $30 a barrel. So it doesn't even have to be you guys who are causing the problems to the lenders, but guess what? All their mortgage loans are starting to have trouble. Any of these lenders who have HELOCs or any other loans secured by mortgages or unsecured credit or credit cards, they're all going to start suffering huge loan loss write-offs. So you got to start paying attention to your lender. You got to be able to read the basic financial statement for your lender and your bank and make sure that they will still be around to lend you money. And I don't care how big they are or how small they are, they're all going to have some trouble. Maybe the Fed will bail them out, but maybe they won't. So just be careful. You don't want to be the one left holding the bag when they say, sorry, I'm not going to fund your draw today. Sorry, I'm not going to give you your cash today. And if you have any questions about how that works, you might want to look up what happened in Cyprus a few years ago when they cut back on all the cash that the big folks had in the bank. So
yeah, Jim,
yes.
I got something from and it looks like the federal government is looking at the potential of $100 billion worth of deficiencies on mortgages.
Yeah, and that's just the first round. So
yeah,
and
that's what they're talking about, that they're going to have to pay attention to.
Yeah, thanks, Chuck. So one thing I want to suggest is if you pay attention and do these plans, you're going to be attractive to lenders, because hardly any of their businesses are thinking about it or giving them plans or document it or talking with them. If you do this stuff, you are going to be the ones that they come to with the great land deals. You're the ones that they're going to look to help them out of the problems that they have. You're going to be highly attractive to the lenders that still remain if you do this kind of stuff. If you don't, then you're just going to be run of the mill. Investors are the same thing. You know, stock and bond markets are becoming more volatile. Their returns are becoming negative. And you know, if the Feds keeps doing all this stuff, eventually inflation may become an issue, and real estate is a decent inflation hedge. In my opinion, investors with money to invest are going to be way more interested in home builders and land developers over the next several years, especially if you got the right product and the well-placed land at decent prices, and you know how to run your business. If you got profits, if you're cash flowing, if you got great plans and in case of reasonable contingencies, and you can explain that to them, you're going to have a lot of people looking to give you money, at least whoever's got money left. I'm going to let Emma Jane start talking about this when she wants, but we're here. We are going to be, we're here to answer your questions. If they're just a few minutes, we'll answer them for you. If they take some more specific understanding of your situation, we've got some reasonable rates and easy ways that you can be involved with this on our consulting services. We're also going to be doing a whole bunch of webinars that replace the seminars we do to help you work through the problems that you face right now in your business, but learn how to do that, whether that's on the financing and accounting side, whether it's on direct construction costs, sales and marketing, just general management, how to handle your land. We're going to be presenting a whole bunch of those things here over the next few weeks and few months. So Emma Jane, if you want to jump in, feel free.
Yeah, and we have one question related to what you just finished talking about. How do we determine if our banks have a lot of loans to oil-related businesses?
First thing you can do and ask them. Next thing is they're required to publish their financial statements. So you can ask them for their financial statements, at least annually and I think quarterly. If they're a big bank, then they're going to be publicly traded and you can get the financial statements that way. But that's one of the easiest ways, just to ask them. Ask your loan officer and ask the president of that bank or the branch and ask them how they're dealing with it.
Excellent. Thank you, Jim. Just to play off of what Jim was saying with all the different things that we can do to help you, remember that we do offer one-on-one coaching and consulting as well. If you want to go ahead and switch the slide, Jim, that would be great. What do we hear? You can go ahead and, this is just a list of some of the things that we are there to help you with. Take advantage of builder partnerships with your relationship with us, making sure you're looking at our newsletter with timely information, articles. We always have up-to-date information on our manufacturers and our service provider partners, and also different educational opportunities that we have. Make sure to take advantage of the person that you're working directly with at Builder Partnerships too. If you're taking advantage of our rebates, they're there to help you also determine whether or not you're taking advantage of all of our rebates. Here's another question, Jim. What options make sense if you have excess cash and concerned about bank risk?
Well, it depends on how much excess cash. I would suggest that you could start investing in treasuries, especially short-term ones. The direct deposit the direct to treasuries is the easiest way to do that. You might want to look at some alternative currencies, whether that's the Bitcoin kind of things, and obviously gold and silver are decent if you got longer term cash needs. You can also start looking at some foreign currency kind of accounts with foreign exchange brokers. If you think that the dollar might be suffering or at some point, or if you even want to hedge that. I think those are a few different ideas that you can use. I think there are also insurance companies that they have different kind of structured investment products or cash value life insurance as well, that you can find ways to have access to those funds. So those are just a few, and I'm not saying all of those are perfect for your situation. It's just kind of a menu of choices in there.
Thank you, Jim. I hope you were able to take a quick look at this slide while Jim was talking. These are some of the manufacturers that we work with, and we have negotiated good rebate programs with all of them. So if you're looking for ways to save money or get money back on some of the products you're using, please be sure to give us a call and we'll see if we can help you with any of those. You can go ahead and switch the slide, Jim. And this just basically goes over what I was talking about. We have our rebates, training on live and live courses. Next week on Webinar Wednesday, we have Ed, who's going to be presenting his value engineering class, how to design a profitable home. We also have our one-on-one consulting, our data transfer, which we just have started working with Mark Systems and Cova. Surveys for builder of choice, employer of choice, those kinds of things. And our builder groups, which is a great option for those of you needing to connect with other builders. I have another question here while you switch the slide, Jim. Would you make any bets on public builders like Lennar who focus on first-time buyers?
What's that now? Investment in Lennar?
Yeah, would you make any bets on public builders like Lennar who focus on first-time buyers?
Yeah, I would at some point. They're going to get hammered. So someday they're going to be really cheap. Yeah. But that's my opinion. But there's all kinds of bets I would make as well. But what I want to be careful of is I don't want to be giving specific stock advice. What I want you to do is think about, here's my game plan as to why I would invest in Lennar and how that fits into my long-term plan. Here's when I would buy it and why I would buy it. And here's the other kinds of companies in other kinds of industries that I would do the same with. I want to be careful that we're not just going according to a pretty natural human nature bias is, if I just pick the right stock, then somehow everything will be okay. I want to focus us on, let's figure out what the investment plan for me is that's correct, and then make sure I'm executing it properly.
Excellent. This slide, I just want to, many of you have probably participated in Emma's annual financial and operational study. She's extended the deadline to May 15th. This is her 27th year doing this study. It is incredibly valuable information. You know, the publics all put their information up on 10Ks, blah, 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 all that stuff. And Emma does an intricate, super detailed analysis of our industry for your size builders, for this size builders. It's great for using for benchmarking and making decisions so that you can see how your company compares to other companies in your same niche in the home building industry. So I highly encourage you to participate. So if you have questions or need a form, you can contact Emma at eshin@builderpartnerships.com. So I think, yep, we can go ahead and go to the next slide.
Okay.
And then obviously we talked about Webinar Wednesday. You can go to our builder partnerships website at builderpartnerships.com/events to see our previous webinars and also any upcoming webinars. And then stay tuned for our HBU, Home Builder University. As Jim was saying, we're going to be doing a couple of classes starting in May. First one is going to be a purchasing class. It'll be on Tuesdays. And then Jim is actually going to be doing an accounting and finance class. How do you know if you're winning? Learn to speak the language of business. So keep your eyes open for that. We'll probably have something out next week so you can start registering for those classes. And if there's any other questions, oh, there's another question. Just some feedback on the F&O study. We love the data. It's too slow to help guide decision-making. Generally, by the time we get the results, yeah. It's a lot of information. We try to get that out in July. We're waiting for everybody to get that stuff in as soon as possible. So if we can get everybody to get everything in as soon as possible, that helps with the study.
I think the other thing is, if you have any information that you want this is all in a database. You got 27 years of information on builders. So we can do trend analysis. We can do all kinds of things. It's got all kinds of salaries. It's got operational material. How many people do I need to have in my purchasing department? How many people do I need to have in my design center? I mean, that's the kind of information that you get. Everything you ever want to know about the home building operation is in that study. And it's all been generated by the builders. We continually ask builders, what additional information do you need? What additional information do you want?
Excellent. Does anybody else have any questions? All right. Well, thank you all for joining us today. We appreciate.
And there's Jim's contact information and our contact information. If you need it, just take down the phone number and Jim's email address is right there. So if you want to have follow-up discussions with Jim, just notify him.
Yep. Yeah, thank you all for joining us.
Thank you.